All righty. Good morning, folks. You are tuned in to the 2026 Giliberto Levy uh, or GL2 High Yield Investor Conference. Welcome. Um, Depending on how long you've been with us, this is our ninth GL2 Investor Conference. It does not seem possible. Seems like a short time ago where we were trying to get to one and then maybe two, but this is the ninth time. So just to bring you up to date a little bit, we'll talk about this in detail with both Michael and Alex. We now have 16 years of history. Who knew? And since inception, uh, we've tracked investments with almost a $500 billion in collateral value. That's trillion with a T. We've also tracked more than 2,700 loans and investments. None of those numbers seem possible, but they're all real. So this is our annual investor conference, and joining me today is my partner and GL1 and GL2 co-founder, Michael Giliberto. Good morning, Michael.
Good morning.
Additionally, today we have invited Alex Michaelis, who is a colleague of ours. And I think most of you, or many of you, already know him. If you've had a technical question about the GL1 or the GL2, actually, in this case, you know Alex. If you want to talk about how the dashboard works, you've talked to Alex. And if you want to do custom benchmarking, then you've definitely talked to Alex. Anyway, welcome, Alex. Nice to have you here with us.
Thank you.
Um, I know many of you are repeat attendees, and we always welcome you back. A bunch of you are new, so let me go over a few house rules, and then we'll dive right in. Everyone is on mute, so if you have questions, ask away. There's a question and answer button. Don't wait till the end. We'll take them as quickly as we can, but they have to be in writing. So just send us a Q&A. We'll get to them. What we found is that we try to answer all the questions online while we're in the symposium. It's not always possible. So if you ask a question and we don't answer it, know that one of us will get back to you directly within a day or two with the answer to your question. Additionally, the session is recorded, and if you'd like, we're happy to send you the video so that you can listen in or listen in again. Julie, are you clicking? Okay, here's the agenda. We're going to start with an index overview. I'll kind of lead off, and then we'll go quickly to Alex. We'll follow up with information on performance. Michael will give us an extensive update on research and where we are, and we'll go over a few concluding thoughts and somewhat of the road ahead. Okay, the GL2, we like to think it's the index for commercial real estate debt. It measures total return and components. But here's the key differentiator in our opinion. We use loan level data obtained directly from lenders. So all the data that we're using, we've gotten it directly from somebody that's originated or bought the investment. It's consistent with other fixed income indexes, including the GL1, stock indexes, real estate indexes. So if you'd like to say, how did the GL2 do to the GL1 over a similar period? We can show you. How did it do to high yield REIT debt? We can show you, or corporate debt, we can show you. The index is designed for portfolio managers and investors, capital allocators, and consultants. The GL2 is a total return index, and here to drive this section is my colleague, Alex Michaelis.
Thanks, John. So, as many of you know, who are participants, data is collected and the index is produced quarterly. With that, we calculate monthly returns. And they're calculated as internal rates of return using daily dated cash flows and starting and month-end valuations. The monthly returns are chain linked to then generate time-weighted returns. This is all done consistent with GIPS methodology. And with that, we'll further break down kind of the total return between income and capital values. So the income return includes cash received plus accrued and capitalized interest and other income, which in this index is generally origination fees and other types of extension fees, which equals the gross income. Then to get to a net income, we take out expenses charged to the loan, and then in this case, oftentimes servicing fees, as well as interest expense for leveraged loans or debt on loans, which gets us to our net income, which is the income return component of the total return. For capital value return, this reflects fundings, principal received, and then any changes in investment value, which excludes changes due to accrued interest, which is part of the income return. And as a reminder to everyone, changes in the investment values are reported directly by participants, and oftentimes this is a blend of internal and external valuations. Moving on to performance, I'll give you a quick snapshot of what we typically see in our report package. But as you can see, we have more than 15 years of data, and the GL2 compares very favorably relative to other indexes, including GL1, which is our senior fixed rate life insurance company type loans, the investment grade CMBS, as well as corporate intermediate high yield index. As you can see, since inception, a 938 versus, we're materially above that over the long run. Moving on to some of the research and analytics, we'll take a look at the market structure. For the GL2, we put together a couple of tables here highlighting the composition of the index. So with that, we can see that the index is primarily composed of leveraged whole loans and mezzanine debt. Off to the right, you see 22.5 and 49.4% of the index are mezz and leveraged whole loans. Another meaningful component is the senior whole loans, which are unlevered senior loans with a variety of other strategies sprinkled in, including B notes and preferred equity primarily. And further stabilized and the bridge transitional, which is kind of more of a light value add type of a real estate strategy, are the predominant components of the overall index from a underlying real estate strategy perspective for these loans. On the bottom table, we show the capital source, and this is dominated by the open-end funds and closed-end funds, the investors who have those types of vehicles that they're investing through, with a smaller component coming from separate accounts and balance sheet lenders. And then every year we like to take a look back at performance and better understand kind of what's going on in the index. And we use this platform as an opportunity to look at realized IRRs, which most folks tend to look at deals in that way. So in this case, we took a look back at the full history of the index, and we identified 642 loans that had complete cash flow data, from cradle to grave. So these are all round trip deals, and were originated or sold off or paid back from 2010 through 2025. And these deals amounted to more than 35 billion of principal. This also included loans with credit events, including realized losses. Um, so for all the loans, the average realized IRR was 10.6. And we did a quick breakdown here between loans that were held less than 12 months and loans that were held for longer, um, recognizing that IRR calculations for less than 12 months produces an annualized return. And as you can see here, uh, there is a slight difference between shorter holds and longer term holds. We further broke down the returns based on the loan type. And as you can see here, there's a dispersion between the various strategies, with MesDebt being a large component of the index and also having the highest average realized IRR, followed by leveraged whole loans, and similarly then by senior unlevered whole loans. So kind of typical of what you'd expect, higher up in the cap stack, higher returns. We broke it down by the underlying real estate strategy. So stabilized versus kind of a light value add or bridge transitional, and then value add, which is generally construction type loans. And as you can see, again, folks are generally getting paid for taking risk. We also broke it down by property type. And again, these are all just realized loans. This doesn't reflect the overall index. But as you can see, there's a breakdown between all the different property types that we're tracking. And I'll just highlight lodging as one example where there's a fairly material difference between the other property types, almost 200 basis points. We also broke down the realized IRRs by vintage year. Your eye probably immediately goes to 2020 with a 18.2% average realized IRR. This is mostly because of shorter term holds and the fees originated. So you got that compounding effect of a shorter term hold plus perhaps a large origination fee. So quick payoff with large income upfront. And while significant downside events remain rare, they do continue to cause a meaningful reduction in the overall average realized IRR. So what we did was we bifurcated the returns based on their ending credit event. So we identified all of those loans that were defaulted or went REO, and took the difference between those returns. And as you can see here, it's only 3% of the overall loan pool, but it did decrease the average IRR by 136 basis points. So similar to what you'd see in like a CMBS pool, where the one or two bad apples spoils the bunch. And with that, I'll turn it over to Michael.
Thank you, Alex. And I'll apologize. I have a little background noise. It never fails. Every year when we do this, uh, an adjacent property decides to have their lawn mowed and
Ours was done this morning.
undertaken. And so I think it's been every year, at least every year for the last few years.
Yes, it has.
I will endeavor to speak loudly and distract you all from the background noise. So what Alex just mentioned about the relatively small number of loans that have experienced severe credit events really do have an effect of dragging down overall returns. So it's appropriate that we also look at credit losses. And again, this is something we started doing a few years ago as we accumulated in the index enough data to really be meaningful. So we were kind of moving, if you will, from anecdotes about what was going on to real honest to goodness data that we could do statistics on. Okay, so what we've done here is same material as last year, but with an update. So we added credit events that occurred in 2025. And also, John alluded to, the index has grown tremendously. And some of that growth comes from backfilling history as new participants come in. And we got a lot of additions, as Alex will attest, in 2025. So what we do is we look at all the loans that have realized losses. And these categories include interest forgiveness. So it may have been a period of deferral. It may be at the back end, some interest is forgiven. But in any event, where the contractual interest was not delivered, we consider that a form of credit loss. Defaults, whether they're partial or full. Now, it's possible that some principal is paid back along the way, and we're looking at these defaults as being, okay, the loan is being disposed of, and all the principal has not been returned to the lender. Sales of non-performing loans fall into this category. Restructures where the principal balance is reduced by more than 2%, we include. And what do we exclude? Well, we exclude loans that were delinquent for a period of time, but eventually cured 100%. Cases where there may have been interest forbearance, but no subsequent credit event. When the deferrals were fully paid, small restructures. And then lastly, a very important note, there are loans that are currently in default in the index, but they're still carried on the books. So what we're looking at in the loss study is crystallized or realized losses. And an important point for me to make is that the returns may very well already reflect write-downs in value. So a loan that's potentially headed for default, in other words, something that's currently non-performing, likely has had a write-down and already had at least part of the potential eventual loss has been in the GL2 return series. It's just not yet shown up in the credit loss because it hasn't been fully crystallized. So again, these are totally realized losses. We've got a couple of ways we look at it. One is by the number of loans. The way to think about this is, we have a population and a part of the population gets sick. So what we're looking at is what percentage or what's the incidence within the population of being ill. The other counterpart to that gives us additional information is, well, just how sick are people, and within the overall population, kind of what's the level of sickness that's taking place. So you could have a lot of mildly sick people, or you could have very few extremely sick people, or some blend. So when we look at the first measure we do, and we're going to look at the credit losses in several different ways. One is to look at the cumulative loss. I think this in some ways is the most telling measure. So what we're going to do is we're going to look at the amount of principal that was lost over the entire GL2 history, which is the time span from 2010 to 2025. So the exposure base, what we do is we want to say, well, what's the capital that was at risk? And the way we measure that is we look at the maximum amount of principal that was ever outstanding on all the loans within the index. And that's the exposure base for this way of looking at credit loss. So you could conceptually think of this as being, well, what if I were an investor and kind of a passive investor and I just owned the entire index for its entire history? What would I have lost? And let's look at that. Well, if we look at the number of loans, so if you will, that prevalence or incidence rate, where every loan gets the same weight, these are just basic averages. The rate of default about 1.6%. The average severity is about 60%. And then if we look at the invested dollar measure, each loss is weighted by the principal balance. And there we get a little bit higher default rate of 1.83%. And the severity drops a little bit to 55. And when we multiply this dollar weighted incidence and dollar weighted severity, we get a credit loss figure for the overall index of a tad above 1%. Last year, that came in at just 1%. So we're up a little tiny bit in it, perhaps significantly, perhaps not significantly, depending on what you think. And we'll talk about that a little more as we go forward. So another way of looking at it, and this is perhaps the most common way in the industry, is to say, well, what's happened year by year, as we call them event years. So here what we're doing is looking not at the overall principal outstanding for the entire life of the index, but just what was the principal, what was the loan count during each event year. So let's take 2025 as an event year. How many loans were active at the beginning, at the end? What was the average? What was the principal at the beginning, at the end? What was the average? And you can see here we get a range of outcomes. I'm not going to walk you through all of them. Our slides are available, and we'll be happy to send them to anybody who requests them so you can look at this in more detail. I want to jump right to the bottom line, though, and point out that when we look at the annual average here, you'll see over on the far right under credit loss, 36 basis points. That's kind of significantly below the 1.02% that I just cited for the entire index cumulatively. And that's an important note, because if I'm thinking about potentially when I'm looking at expected returns from this, do I want to look at the average annual loss or the cumulative? I kind of lean toward looking at the latter to get a feeling. And that's a higher number than what we get on average for the annual. And again, we'll see some of this as we look at a couple of other ways of slicing it, one of which is by vintage year. So here what we do is, instead of, again, looking at the entire index or the entire index within an event year, we look at the outstanding principal, but broken out, again, cumulatively over time, but broken out by vintage year. And here at bottom line, again, you can see a time series of patterns here. But the bottom line is this is a higher average than you get looking at the event year basis. And again, I think if one's trying to understand on a long run basis what we might anticipate for credit loss in this and what's been the experienced credit loss, this kind of annual average of the vintage years is probably better, because this takes into account the fact that loans have different terms, they're originated at different points in the credit cycle, et cetera. And it's also relevant to consider that these are relatively short-term loans, typically 2 to 5 years. One of the slides Alex showed indicated an average holding period of actually a little less than 3 years for the cradle to grave data that we have within the index. So these are short-term loans, and clearly loans originated in 23, 24, 25, not all of them have reached maturity, and we don't have a full credit history, full realizations on these loans to know what, if any, credit losses will be experienced in those vintage years. My bet is the likelihood is that there will be some. They won't remain at zero. Another point that's very relevant, when we look at property types, I don't think anybody's going to be shocked by what's on this chart. We use the same calculation that we used for the cumulative loss. So these are basically the cumulative losses, but now by property type. No surprise here, office is the highest. If anybody is shocked by that, I would be stunned and wonder what data you've been looking at. Apartments have a relatively benign credit loss history, even though they're a fairly large component of the index. So they're not contributing a lot to the overall credit loss. Lodging is, though. Lodging in GL2 is certainly higher than it is in GL1 as a percentage of what's outstanding in the index. And it's had some tough times. Certainly, COVID era, as everyone knows, is very difficult for the lodging industry, and that's been reflected in the credit loss history that we've got here as well. So the main drivers really, as I say in the third bullet point here, is it's really been office and lodging driving the overall cumulative. Retail has a relatively big-ish, in other words, higher than the average credit loss. But retail is the smallest sector within GL2, or at least certainly it's the smallest sector currently. So higher losses, but within the overall index, a very low contribution to losses. Okay, so that's what the loss history has looked like. What does it look like going forward? Right. So what might realized losses be? Well, I'm repeating here a chart that we used last year. Bit of explanation merited here. The kind of orange or brick colored line is the value drawdown, CR here, meaning commercial real estate, of course. This is taken from the NCREIF index, or we use the NCREIF index for this. So the mix here of property types is what the NCREIF index holds. And the reason we use that is that mix is fairly similar to the mix of what life insurance companies hold in their commercial loan portfolios. And we're using that, the ACLI statistics for commercial mortgage loans for the credit events, which are the blue line. Now, what the update here is showing is that it looks like the drawdown from the most recent credit cycle has ended and values are on the upswing overall within the NCREIF index. They're certainly not so much in the office sector, but on the upswing. And we're going to return to the sectors as we go through this outlook. So what that, not surprisingly, showing is it also looks like the incidence of credit events has come down as values have, if you will, stabilized and even now showing a little bit of uptick. Not a rebound to where they were by any means, but a little bit of an uptick. Now the question is, what does this mean for GL2? This is a new slide this year. With the large amount of additions of data backfilled into GL2, thank you, Alex, for all that work, we've been able to generate a more robust statistical series of the overall of the incidence of credit events within GL, and also to look at the drawdown, not using the NCREIF weights, but using the GL2 weights. So this drawdown, again, the orange or brick colored line, reflects what the GL2 looks like as of December 31st. Because remember, we're talking here about forward risk exposure. So this is showing GL2 composition as of year end. There's been a drawdown. It looks like we've stabilized, maybe starting on a gradual path of recovery in the values in it. And it looks like we may have passed the point of peak credit effect occurrence in the index. Again, that would make sense. It seems to show similar pattern to what we saw with, call it, the life company and stabilized property valuations. And important to remember here in GL2, we're not dealing with just stabilized properties, but as the market structure slide shows, a fairly high component of light to heavy value added as well. And the drawdown is not reflecting what happened in that sector, which we would believe to be more severe than what happened in the stabilized sector as far as values. So let's look again at the outlook here. Well, certainly changing property values, which affect loan to value ratios, are a big deal. But the poster child here is office. Office values have fallen, depending on which year, vintage year of origination you look at. Office values have fallen, and unless it was a very recently originated deal, of which there are not many, uh, as I know
Yeah,
John
really
shaking
not.
his head, and I know he's uh, not seeing a lot of office activity.
Nope.
Not that there isn't borrower demand, but investors have been pretty cool to the sector. Again, a point we should return to in our conversation. Uh, the other thing that I'd like to highlight is there's risk in multifamily for loans that were originated at the peak value years, which be kind of 22, 23. So sort of after COVID was worked through, apartment values were on the upswing. People felt pretty good about apartments. And then, of course, we got into the regime of rate cuts, rate hikes, rather, uncertainty. Um, and we've moved forward from that, and we're coming back to that rate hike thing. Um, Older retail has a risk, but as I've mentioned several times, not a big component of GL2. So retail doesn't present as much of a risk factor, even though the values have been compromised. Industrial, very modest in a couple of peak years. Again, not serious enough to really affect lending other than possibly asset specific. So I am certainly talking about macro level factors here. And as everybody knows probably all too well, certainly those of us who've been operating in this business for a long time, the macro is one thing, but asset specific factors, loss of a tenant, tenant bankruptcy, whatever it may be, can certainly have effects to drive a loan into a weakened credit condition, even when the macro environment remains relatively benign. The lodging is a little odd because NCREIF doesn't have very much or very deep lodging data. So we've used it, but based on the credit loss history that we've seen in GL2 for lodging, I'm not sure I would rely on the NCREIF value indicators in the lodging sector. So we still think there is risk in lodging. So let's talk about what's happened to loans in the GL2. Here, remember, the realized losses are the realized losses. Those loans are done. What we're looking at here is going forward. What might the future bring? We'll start off by focusing on the subordinate debt. So the mezz, the leveraged whole loans, the B notes, the pref equity that's in GL2. As of year end 2025, we want to look at things. Well, as of year end 2025, we've got a lot of origin years in GL2 data. And we know what was underwritten. And these were the cap stack positions as they were underwritten. Kind of the average 50 to 70% is where the subordinate debt. So again, whether it, mezz may be a little higher, leveraged whole loans may be a little lower when you take the combined effect of the financing put in place and the LTV of the senior loan. But where have these gone as a result of those value changes we just looked at? Well, if we look at the migration, we're going to see a bunch of orange dots show up. And these orange dots are where these capital stack positions are now, at least as they would be using the NCREIF value changes sector by sector applied to each active loan, each active sub-debt loan in GL2. No surprise, there's been movement upwards and to the right. And let's see what's moved into the red zone. And it's really mostly been office that's driving an average increase in cap stack. Let's go to the next chart. And so these are those things up. And we've highlighted here a red zone where the upper LTV or the detached point is moved up to 95% or higher. So we'd regard these as the existing positions where losses may have been partially recorded in values and hence reflected in GL2 returns, or they may not have been. So what's in this high risk box? Well, again, no surprise, mostly office. There is some apartment, and the rest is other. So those are the sectors, again, vintage for office, vintage year, pretty much any vintage year office, you've got risk from a valuation perspective. Peak origination years, you got risk in the apartment sector. And the severities here, this is again a guesstimate of what's exposed currently. And if you took the value as calculated, again, using macro numbers, not collateral loan by loan specific collateral values, we get these kinds of severities, which are actually a bit low for office, a bit lower than the realized severities in the credit loss data. For multifamily, a bit higher than the realized severities in the credit loss data. So this is value. And the senior loans, I'm not going to spend any time here other than to note that very few of them have moved above 95%, although and only a small number have really had significant upward migration in the upper end of the value range. So, and those that have moved up, office and apartment, again, kind of keeping on that same theme from before. So let's talk about income. We've had a lot of movement in income, again, mostly for every sector, but unlike the changes in values, other than office, most of the sectors have actually seen improvement in income streams over the years. Pretty modest in the case of recent origination years, but fairly substantial. Look at industrial. 2018, in an origination on a deal in 2018, on average, at a macro level, those income streams have doubled over that long period. So we're really other than office and looking at debt service coverage, the income from the property sectors is pretty good. It's actually been a positive, a supportive factor. So if you will, improving credit statistics. Well, where's the culprit? Well, the culprit has been interest rate increases. So we've here used SOFR, which these days is the most common index that we see in GL2, which is U.S. product originated floating rate loans. So of course we have the early period kind of moderate economic environment, moderate rates. Then we've got COVID, rate cuts, zero interest rate environment, and then the rate hikes that we've had over the last few years, and then moving to an easing environment recently. So that lower table, which is kind of in the bottom and over to the left of the SOFR chart, has red and green. Well, red here is, as usual, red is bad, but red is positive numbers. Well, why is it positive numbers? Because these are the origin years where the rate today is higher than the rate was in the year it was originated. So depending on what was used as a long-term interest rate, or let's say a long-term SOFR expectation, or may have been LIBOR in the early years expectation to establish the debt service coverage ratio, likely now the increase in interest rates has caused the debt service coverage to worsen. Whereas in contrast, can we go back to the prior slide, please? In contrast, some of the more recent years, 23, 24, 25. Now, there was some chilling of originations because of the rate environment and uncertainty. But at least for the loans that were originated, interest rate movements have had a beneficial effect on debt service coverage. So taken all together, as you would expect, right, this shows sort of a mixed bag of potential interest rate effects. And if we go to the next slide, that's what we can see. So the improved DSC looks like the chart's got blue, and the legend says green. So pretend that the blue on the left side is green, and the orange was red, and it's now orange. So those are the worsened and the better. Um, so 57% have gotten better, 43% have got worse. So kind of, a little bit better overall, but certainly some new risk being introduced in the coverage ratios. Again, no surprise, the chart on the right showing where these increases are concentrated, right? If things improved, it's not a risk factor or a risk exposure that we need to be concerned with looking at the forward outlook for credit losses. It's the ones that have worse debt service coverage. So we looked at what's gotten worse from a value perspective. Here's what's gotten worse from an income and debt service coverage perspective. No surprise, a lot of office in the worsened have worsened. A fair number of apartments have actually worsened. Again, think short-term loans, a lot of origination, some peak years of valuation occurring. Retail, again, worsening, but not a concern because it's such a small part of the index. Unless you have a retail loan, then yes, pay attention. Industrial, surprise, surprise, not a problem. Values on the up, even if maybe some of the very recent vintage years may have taken a little bit of a hit in mark-to-market value, but not enough to crush, the equity cushion in the cap stack positioning, and the income streams, as we've seen, have generally experienced very robust growth. And the other has, which does include lodging, mixed use, and the miscellaneous other, has also gotten a bit worse. So where do we end up? Well, we said we were entering, this is back in the middle of 2025. We said we were entering a period of peak resolutions where we thought the pace of resolving credit issues would likely hit its peak either later in 25 or early 26. Certainly those charts earlier of both the life insurance company and NCREIF credit events versus value drawdowns, and then the value drawdowns and GL2 credit events suggest that with the drawdowns having stopped, so in other words, value for the most part, looking on a macro case like it's stabilized to rebounding, we certainly look like the realized credit events have peaked and are slowing down. And another way we can look and maybe have some confidence that our mid-year outlook or mid-year last year outlook on realizations is the chart on the right. So the orange bars are the dollar amounts of non-performing loans, NPL. Sorry, we forgot to put the explanation on the chart. We'll rectify that before we send the slides out. So at the beginning of the year, these are the dollar amount of loans that were not performing. So delinquent or defaulted in GL2. The blue is the amount of loans that were resolved during the year of the non-performing loan group. So yeah, there were other loans paid off, but we're focusing here on the NPL group. So as you can see, what's happened is the NPL group has been declining and the resolutions have been increasing. So we think our prognostication in mid-2025 has largely been correct. So if we go to that title, there, it seems to be playing out as we projected, and then we'll kind of leave it up to everyone. Sort of, what do you think?
Let us know your thoughts.
Where do things stand? So that kind of concludes my spiel. My screen does not show me if we've had any questions. I'm going to flip this back to John.
Michael, we've got a couple that I'm going to
and see if we've got some questions.
We'll send to you separately if you don't mind.
Okay.
Okay, so just a couple of reminders. The conference has been totally recorded. So if you'd like a a copy, let us know. Julia Grant is the key for that. In addition, we'll send out a Zoom survey, which is your way of telling us what you did and didn't like. So please fill it out and let us know. We read those intensely. I think as Michael has said and Alex knows, we've had a dramatic increase in the amount of participation and data. So if you would like to be in the participation group, let us know. If you have data, let us know. We'd love to have you join the GL2. On an ending note for this conference, we've had a number of participants that have started to send us European data. And as you know, both the GL1 and the GL2 only have US data. And one of the things we've been asked is, we are an American-based company, or maybe not. We have a lot of American data. We have European data, and we'd like it evaluated on the same platform. Can you do that? So hopefully coming to a place near you, we will have what we call the GL3, which is the GL2 high yield, but in this case for European assets. So we've already had some people started to send in their GL3 assets. If you'd like to be in the GL3, please let us know. We'll show you how to do it. And we look forward to welcoming you to one or more of the GL indices. Okay, Michael, I think that does it for the day from a time point of view. So thank you to Michael and to Alex. We enjoyed having all of you. We will get back to you on some questions that are asked that just don't seem to fit into the time or the structure of this morning. So thank you very much. Have a nice day.